Have you ever wondered why a closed-door meeting of bankers in Washington, D.C. can send the price of Bitcoin, a supposedly decentralized global asset, either soaring or crashing? It's a really powerful and honestly kind of counterintuitive force in the crypto market. So today, let's break it all down. Okay, set the scene. It's March 18th, 2026. The head of the U.S. Federal Reserve, Jerome Powell, basically admits he's flying blind. Now, this isn't just some off-the-cuff remark. It's a confession of pure uncertainty from arguably the most powerful person in global finance. And you know, when the Fed chair says we really don't know, markets, they get nervous.
And by nervous, I mean this. In just the 24 hours after Powell's comments, Bitcoin's price plunged 5.4%. So how does a non-decision, just a simple hold on interest rates, trigger such a violent reaction in crypto? Well, that's the exact puzzle we're going to solve today.
So first up, let's really unpack that specific event, the March 2026 Hawkish hold. Because if you can understand what happened there, you can understand the why behind all of it.
You know, on the surface, it really looks like nothing happened. The Fed kept its main interest rate exactly the same, but the market called it a hawkish hold. So why hawkish? Well, because even though the rate didn't budge, the Fed's whole attitude got a lot tougher. They actually raised their inflation forecast for the year, and their own projections started signaling that investors should probably only expect one single rate cut in 2026. That just shattered everyone's hopes for easier money. And the reason for all this pessimism was pretty clear: rising oil prices thanks to geopolitical conflict.
Which, of course, brings us right back to our main question. It wasn't a rate hike, so why the big panic? The answer, it turns out, lies in these invisible mechanics connecting the Fed's boardroom all the way to your crypto portfolio. So how exactly does a policy announcement in D.C. have such a direct impact on the price of digital assets? Well, let's take a look at what I like to call the Fed's master levers.
First, and this is the most important one, is liquidity. The easiest way to think about it is just easy money. When the Fed cuts interest rates, borrowing gets way cheaper. This just floods the market with capital, and all that cash starts looking for higher returns and riskier assets. And you better believe Bitcoin is a prime destination for that speculative money.
The second lever is pure market psychology, or what traders call risk-on versus risk-off. Just think of it as the market's overall mood. Risk-on is when the party's going. Money is cheap, everyone's feeling optimistic, and investors are eagerly buying up things like tech stocks and crypto. Risk-off is when that party ends, abruptly. Fear kicks in, and investors start dumping those exact same assets and just rush to the safety of government bonds. A hawkish message from the Fed can flip that switch from on to off in a blink.
And this slide really lays out the whole mechanism perfectly. When the Fed hikes rates, or even just signals they're going to stay high for longer, liquidity dries up, the mood turns risk off, and the US dollar gets stronger, which actually makes Bitcoin more expensive for anyone buying with other currencies. But when the Fed cuts rates, it's the total opposite. Liquidity expands, the risk-on party gets started, and a weaker dollar can make Bitcoin look a lot more attractive. These are the powerful tailwinds that can seriously drive a crypto bull market.
Okay, so that's the theory, but how does this actually play out in the real world? Let's look at a tale of two very different interest rate cycles and see this whole mechanism in action.
I mean, look at this timeline. The pattern is just crystal clear. Back in 2020, to fight the COVID slowdown, the Fed opened the floodgates. Rates hit zero, liquidity surged, and Bitcoin went absolutely parabolic. Then, 2022 happened. To fight inflation, the Fed hikes rates aggressively. Liquidity just vanished, and Bitcoin crashed. Finally, in late 2024 and into 2025, the Fed pivoted, and just like that, Bitcoin recovered spectacularly. It's almost a perfect demonstration of the theory we've been talking about.
But of course, it's not always quite that simple. Come on, if it were, we'd all be retired on a beach somewhere, right? There are other really important factors that can muddy the waters and make this relationship a lot less predictable.
A huge one is what we call the priced-in effect. See, financial markets are constantly trying to predict the future. So if everyone expects a rate cut, investors will buy Bitcoin before the Fed's announcement, driving the price up in anticipation. Then when the news finally drops, the news everyone already expected, it can actually trigger a sell-off as traders take their profits. It's that classic buy the rumor, sell the news scenario.
And let's be real, crypto has its own internal drama. A massive development like the approval of a Bitcoin ETF can unleash a wave of buying that completely ignores what the Fed is doing. On the flip side, a disaster like the collapse of FTX can cause a market crash even when the bigger macro environment looks positive. These events create their own little weather systems. And this chart right here shows another key factor. Uncertainty itself is a huge deal. The blue line is a measure of monetary policy uncertainty, and the orange dots, those are Bitcoin returns. The pattern is pretty clear. When uncertainty rises, returns tend to fall. This goes right back to that Jerome Powell quote. When investors are scared or just unsure, they switch to risk-off mode and sell. Sometimes, the lack of clarity is even more powerful than the decision itself.
All right, so let's bring all of this together and start looking ahead. Based on everything we've just covered, what are some of the potential scenarios for Bitcoin as we head into the second half of 2026?
So this table lays out three pretty distinct possibilities. First, you've got the bull case. This is where geopolitics cool down, inflation falls, and the Fed feels confident enough to start cutting rates. That improves liquidity and creates a very bullish setup for Bitcoin. Then there's the base case, which is basically more of the same. The conflict and inflation stay sticky, the Fed stays on the sidelines, and we get a choppy, sideways market. And finally, the bear case. The war intensifies, inflation roars back, and the Fed is completely stuck, unable to cut rates. This would tighten financial conditions and create a high probability of a much deeper drop in price.
Okay, so what are the key takeaways from all this? First, just expect more volatility. That March 18th decision really locked that in. Second, don't just fixate on the number of rate cuts. Instead, watch the bigger trends, global liquidity and real interest rates. And by real rates, we just mean the interest rate you get after you subtract inflation. That's a huge driver. And finally, you just have to remember that Bitcoin is now super sensitive to macro news and world events. That's the new reality.
And all of that leaves us with one fascinating final question. You know, Bitcoin was created to be an alternative to the traditional financial system. Yet, as it's grown and gotten adopted by mainstream finance, it has become deeply, deeply entangled with the decisions of that system's most powerful institution. So will Bitcoin ever truly break free from the Fed's gravitational pull? Or is this dependence just the new reality for major digital assets? That's definitely something to think about.